Good evening. This is Kim Renners. I am the Director of Wealth Management for OJM Group, and welcome to our webinar this evening, Seeking Returns in a Sideways Market. Tonight, myself and my colleague, Andy Taylor, will be talking to you about some different investment ideas, a little bit of a historical market perspective, and really giving you some good ideas for really returns in today's market. So thanks for taking the time. We're going to go ahead and get started. I did want to let you know that during the course of the webinar, you should have a box there on the side of your page, and you can go ahead and ask us questions. We'll most likely answer all the questions at the end of the presentation, so feel free to ask throughout, and we'll take care of them at the end. So let's go ahead and get started this evening. Here are some topics for today. So we're going to talk a little bit about OJM Group, who we are, what we do exactly. We're going to give a historical perspective on market movements, as I've already mentioned. And then we're going to talk really specifically about 3 investment strategies to guide you through a sideways market. And as I mentioned, feel free to ask questions throughout the presentation, and we'll look to answer them sometime during the end. We'll spend about 40 to 45 minutes giving the presentation and really look forward to talking to everybody tonight. As I always like to say, no good investment presentation would be complete without at least 2 pages of disclaimers. So here we go, page 1 and page 2. I'm not going to read through the bullets. I will save everybody that agony. And we'll just go ahead and get started. So really, who is OJM Group? And what do we do? So we are a wealth planning firm, a financial consulting firm. We're multidisciplinary. We have many experts in many fields. We have CPAs on staff. We have investment advisors, insurance experts, certified financial planners, etc. We offer a broad range of services for high net worth individuals. We actually have a very special niche in the physician space. We work with physicians individually and their practices as well. And then also work with business owners on occasion. You can see here on this chart, OJM Group is really the integrated planning solution, green bubble here in the middle. And then the Odell Group, or OJM Group as well, the investment division, is up here on the left corner. And so we're a registered investment advisory firm. We're registered with the SEC. And Andy and I are really responsible for talking to clients, monitoring the markets, trading, analysis, due diligence, finding good investment solutions and objectives really to help our clients meet their retirement needs. We have a team of a number of investment people as well. Andy and I lead that team, and it's really a good time. So we hope that we can offer some really good ideas for you tonight. So I'm going to move on to the next slide and just say that everybody on the webinar, we're going to receive free materials, but they're not showing up on my screen here for some reason. OJM Group's partners, Jason Odell and David Mandel, have done a really good job of publishing a number of books, some books specific for physicians, others for business owners. And the books really go into a lot of detail about asset protection, taxes, business planning, individual planning, retirement planning, cash flow, etc. So at the end of the presentation, we'll give you an opportunity to let us know if you'd like us to send you one of these free books. And I apologize, they did not show up on my screen here. So Andy and I, as I mentioned, really run the registered investment advisory division at the firm. And we believe we add value to client accounts in a couple different ways. So number one, we take an institutional investment approach for every single client. A lot of the retail clients that we see that come to us have a portfolio of traditional asset classes. And when I say traditional asset classes, I mean stocks, bonds, and cash. And there's really a lot of additional asset classes out there that are very important in today's, markets in a portfolio. And we're going to go into some of that detail later in the presentation. But if you think about an institution like a pension fund or a hedge fund, an endowment, you'll look at their asset allocation and you'll realize that, maybe 50 or even 60 or 70% of the portfolio is allocated to the alternative investment space. And so that might be hedge funds, or that might be commodities, or that might be private equity. And we've realized that not only can the institutions do that, but so can the retail clients. There's so many products available in today's market that allow us to add that extra value and extra return into the portfolios. And actually adding a lot of those alternative investments actually reduces risk. So we'll go through a little bit of that as well. I think another great thing about the firm, as I mentioned, we have a team, and we are dedicated investment experts. So we are here to really watch the market. We've been talking about Facebook all week, getting indications of interest in for clients. We've been, seeing what's going on in Europe. We were talking to a client earlier this evening about the scenarios that may, go down at some point in Greece or in some of the peripheral countries. So that's all we do all day long. We do webinars on occasion. We do some education, but our real focus is to, make sure we're following the markets and understanding what's going on. We definitely use asset allocation in client portfolios. We give, an emphasis to alternative investments, as I've already discussed. We believe that makes sense, whether it's 20, 30-ish% of your overall asset allocation. And then when you do work with our investment team, you'll realize that you have your investment experts working for you, but you have access to all the other experts that I mentioned that we have in-house. So Carol Foos is our in-house CPA. She'll take a second look at your tax returns. David Mandel is our in-house attorney. He can give various suggestions for asset protection planning. Jason Odell, our other partner, insurance expert, cash flow expert. So you have access to all those experts, and we think that really adds value in the grand scheme of things. So with that being said, thanks for the introduction time. I'm going to turn the presentation over to my colleague, Andy Taylor, and he's going to take us through a few slides here and give really a historical perspective on market movements. So Andy, I'll turn it over to you.
Thank you, Kim, and a special thanks to each of you who have taken the time to tune into our webinar. We understand you're busy, and our goal this evening is to make sure that this is a productive 45 minutes or hour for you, that you find educational, and hopefully you walk away with some ideas that allow you to become a more successful investor, of course with the help of the OJM investment team. So in light of the recent economic developments and with the financial crisis of 2008 still fresh in the minds of most investors, we felt it would be useful to revisit history before jumping into the current financial environment. The term lost decade has been thrown around by members of the media, and the amount of negativity that we're presented with on a daily basis can have a substantial impact on our perception of the financial markets. If we jump in our time machine and go back to the 90s, the common expectation among most investors was exactly what history had provided. It's easy to forget that there was a time where we expected 8 to 10% per year on average over a reasonable period. The last 75 years had actually offered us almost precisely those returns. From 1926 to 2011, the annual return of large cap stocks was roughly 9.8%. Small cap stocks were up 11.9%, government bonds up 5.7%, and treasury bills up 3.6%. And if you look at the chart in front of you, it will show you that the last 20 years have also been productive for investors, with small cap stocks leading the way at 11.2%, government bonds coming in at 8.8%, large cap stocks at nearly 8%, and treasury bills slightly over 3%. So we have at this point added a poll question, and that should be coming up on your screen shortly. And the question, as you can see, is what has been the compound annual return of small cap stocks in the last 10 years? So I'll allow everyone to take a moment to answer the question, and then we'll jump to the next slide shortly, which will actually give away the answer. And I do know that you didn't tune in to hear an abundance of statistics, so I promise I'll limit those going forward. However, we did feel that some of these numbers may actually be surprising to you. And the question is, did we really have a lost decade of investing? And you can see the results where the numbers were fairly split, but most of the guesses coming in at 7% and 2.1. So, Kim, if you want to go ahead and move to the next slide. So you'll see that the answer actually was 7%, which you may find a bit surprising. In the declining interest rate environment that we experienced, fixed income investments did actually lead the way as an investment opportunity. Small cap stocks did offer some level of growth in client portfolios. Most of the return that you see there from large cap stocks came in the form of dividends. Now, clearly these weren't the results that investors were expecting when they placed their money in the market 10 years ago. However, a properly managed portfolio did experience an increase in value over this period of time. Now, the last 3 years has actually provided a much more desirable scenario for equity investing. We've seen the S&P nearly double in value. Companies have record levels of cash on their balance sheets. Fundamentals and valuations of stocks are considered reasonable. And as the current earnings season comes to a conclusion, we've experienced 12 consecutive quarters of profits exceeding expectations. So why is there so much concern today? When one of our owners, as Kim had mentioned, Jason Odell, is on the road meeting with prospective clients, the most frequently asked question he receives is, how do you make money in a sideways market? Influent investors are concerned about what the future holds. So let's spend a few minutes assessing why some of these concerns are valid. Interest rates, debt, unemployment, and limitations on future government stimulus are all factors that could limit the return on traditional asset classes. So let's start with interest rates. 10-year treasuries have been yielding around 2% for the last few months, and as a matter of fact, they were down to a range of about 1.75 this afternoon. The Fed is pledged to keep short-term rates low until 2014. Savers are obviously not being rewarded in this environment. After taxes and inflation, the real return on most treasuries and CDs are actually negative. You can see there's been a consistent decline in treasury yields over the course of the last 30 years, creating what many would call a secular bull market for bonds. Now, bond prices and interest rates move in opposite directions. So fixed income investors have experienced not only returns from the coupon payments on their bonds, but they've also been the beneficiary of capital appreciation on many of those conservative holdings in their portfolio. So this isn't a trend that we feel can continue indefinitely, and at some point it will actually reverse course. Now, what that means is when interest rates do rise, the value of your existing bonds could see a decline in value, at least until they reach maturity and your principal is returned. And let's move on to the second point, or the second area of concern that most investors have, and that's debt. What you'll see in front of you is a ratio of various developed nations' debt to gross domestic product. We continue to see increasing debt loads in developed nations, and you'll notice Japan's probably in the most dire situation when we look at their ratio of debt to GDP. And again, GDP is just simply a measure of the goods and services that are produced in a country. I won't spend the time recapping the Greece story here. The media has done, I think, a fine job of that. You can see where the United States stands versus some of the other developed nations. While the numbers in the U.S. are less than optimal, I think the bigger issue our country faces is the direction that we are headed as we move to the next chart. You'll see that within 5 years, without substantial changes in our current system, that health care and Medicare will represent nearly 30% of all government capital outlays. That figure was only around 5% 20 years ago. So that's why you've heard that healthcare is such a hot topic in Congress. It's going to be a significant factor as it relates to the election. So if we move on to the next topic or next area of concern, demographics. Demographics are also unfavorable. With both the U.S. and the developed nations in the rest of the world are seeing disproportionate aging of their working population, and that is very, very likely to continue to accelerate. So what this means is there are fewer workers per retiree, which raise concerns about the ability of a diminishing workforce to support a large segment of the population in those countries. So the end result is we will have a declining labor participation rate, which ultimately results in lower unemployment. However, the lack of jobs continues to remain a substantial issue today. The chart in front of you will show you the unemployment rates in nations around the globe, with Spain currently approaching 24%. Europe's been in the news daily due to their large debt levels. We feel that further restructuring of European debt is highly likely, and defaults certainly aren't out of the question. So achieving growth with high levels of unemployment creates a very challenging environment. To a lesser extent, we're facing the same issues here in the United States with an 8.1 unemployment rate. So this is a very significant concern of the Fed, which brings us to our next point. What exactly is the Fed going to do, and why does it matter? Now, the Federal Reserve isn't necessarily better at forecasting interest rates than any other prominent economist. So why do we have such a great interest in their thought process? Well, unlike other economists, they have the ability to control monetary policy, and in turn, they have a unique ability to influence financial markets. So they're currently faced with the task of promoting growth while working with the government to manage fiscal deficits. So what we do know is that the Fed will avoid deflation at nearly any cost. Kim and I each had the opportunity to hear members of the Fed speak on separate occasions, over the course of 3 to 4 years, and the message that we have gotten from the Fed, and if you look and listen to Bernanke speak, that message has been very consistent, and it's that a deflationary environment is something that they're going to avoid at all costs. It's the worst situation for financial markets. It causes declining home prices, declining wages, and it results in a general lack of access to credit. The story of Japan is fresh in Bernanke's mind. If you recall, Japan's economy in the 80s and 90s, they had cut interest rates to nearly zero. Everyone expected Japan to take over the world. They had the best technology, but essentially what happened is after Japan had cut rates, the first sign of growth that they experienced, they prematurely began to reverse course and raise rates. Why the rate increase wasn't the sole reason for the problems of their national economy, and it was a move that impeded growth for years, and Japan has experienced minimal growth for decades. The Fed's current position is that they are willing to accept a moderate level of inflation, as this is the ideal environment for financial markets. Tame inflation results in increased wages, larger corporate profits, increasing consumer spending, and just fosters a general environment of growth. So it's for these reasons that we feel very confident in our prediction of moderate growth and a gradual increase in interest rates in future years. The minutes of the last Fed meeting were released today, and they made it clear that they are willing to provide additional stimulus if necessary to fight deflation. So, with all that in mind, the Fed continuing a policy of easing, a natural follow-up question would be, well, why would we not experience strong growth? And with the Fed, continuing to operate in this kind of environment, will we be poised for a continuance of the last 3 years? Well, there are a couple critical reasons. Unfortunately, tax rates are highly likely to increase in the next few years. What you're staring at in front of you is just a historical chart on taxes on the highest income bracket. So we are in a period where rates are relatively low, and we're going to have going to need to have some form of additional inflows in the government or by the government. Most of the Bush tax cuts are set to expire at the end of the year. While it's not a given that we'll see significant increases immediately following an election year, an increase in rates is the most likely scenario. Why does all this matter? Higher taxes generally result in a reduction of consumer spending and are typically not favorable for economic growth. Point two, if you want to move to the next slide, Kim, federal stimulus has played a key role in the rapid ascent of stock prices in the last 3 years. And I actually found this chart to be very eye-opening. You're viewing a chart of the price movement of the S&P placed over top of periods of Fed intervention. So the impact of the last 3 rounds of federal stimulus has resulted in substantial stock market rallies. We may see another round of easing from the Fed, as I mentioned a few minutes ago. However, our economy at some point is going to have to stand on its own 2 feet in the near future without the benefit of that additional stimulus. I will say that we don't anticipate long-term rates soaring anytime soon. There is an interest in keeping rates contained due to the amount of federal debt and the fact that lower rates make it much easier to service that debt. To put this in perspective, a 1% increase in interest rates means an additional $150 billion in debt service cost. Last year, the Fed implemented Operation Twist, which was simply the selling of short-term securities and buying longer-term securities with the interest of keeping rates lower. They were responsible for nearly 70% of Treasury purchases in that 5 to 30-year range. So without similar intervention from the Fed, we do expect a moderate increase in long-term rates. However, we will continue to operate in an environment of returns where fixed income investments are well below historical averages. So with all that being said, I haven't exactly painted a picture of sunshine and rainbows in the last 20 minutes. So let's reverse course and provide some reasons to be optimistic about the future. As I mentioned a few moments ago, U.S. companies have record levels of cash on their balance sheets. Kim will provide some supporting statistics shortly to show you that the dividend payout ratios are near historical lows, which provides plenty of upside for increase in those dividend rates. Over the past 4 decades, the dividend growth rate of S&P companies has outpaced inflation. Emerging market countries are becoming less dependent on developed nations, and we see this as a positive. As their wealth continues to increase, consumption's trending upward, and exports to one another becomes a larger component of the GDP of developing economies. Housing is another positive. It's showing signs of bottoming. We've gone from 11-month supply of housing inventory to a 6-month supply. Basically, we've had next to no new construction over the course of the last 3 years. So we're not dealing with the oversupply issue that has been problematic for the housing sector. News came out today that the Housing Affordability Index reached an all-time high. And we've also seen a substantial decline in the correlation of asset classes, and we have every reason to believe that trend will continue. In our opinion, this is a positive development, and it creates opportunity. And when we enter the maturing phase of a recovery, this is very typical. So, the chart in front of you will show you that there's not really a consistent pattern in terms of the returns from various asset classes and various sectors. But what this does indicate is that by taking gains and reallocating, had you implemented that strategy over the course in the last decade, it would have resulted in significant outperformance over a static investment in a vehicle like the S&P 500. You likely could have seen additional gains in the neighborhood of 2 to 3%, which in and of itself doesn't sound like a huge figure, but on a cumulative basis, compounded can be substantial over time. And, we feel that the research and quality is likely going to be rewarded in the maturing phase of a recovery, and there will be a greater need to be invested in the proper securities. So the challenge investors will face in the next few years will be identifying where to invest in order to optimize returns in an environment where traditional asset classes may offer results that lag lag behind those historical averages. So Kim will now spend some time discussing specific strategies that we believe you can implement to be successful in the current marketplace.
Great, thanks Andy, great job. So let's move on then to a couple different investment strategies to guide us through a sideways market. First, let's define a sideways market, though, for everybody here, because I just want to make sure everyone's clear and we're all on the same page. So basically, sideways market, reading these three bullets, can occur in any market. It's not just the stock market. So it could be bonds, it could be commodities, it could be currencies. There's a lot of press oftentimes just about the stock market, but there's other asset classes out there that sometimes aren't really, discussed as much. So I want to make sure, we were all clear that it could be a sideways market in any of these different areas. So sideways means we're not going up in a trend, we're not going down in a trend, we're pretty stable. You might go up for, a short period of time and then reverse and go down. Pretty even intervals, just no consistency. So there's a group of managers out there called managed futures managers. And, that group has really struggled over the past 1.5 to 2 years simply because, there has not been a good trend in the market, and they're often known as trend followers. So they aren't going to try to time the top or the bottom, but when they see the market potentially moving upwards, they're going to get in, they're going to buy. So we've seen that here, recently, past year, whatnot, and then all of a sudden there's a quick reverse. Oftentimes that's happened more on the downside where the market seems to be trending down. There's a lot of news about whether it's Europe or the U.S. or our debt being downgraded. And Andy showed you the one slide, then the Fed stepped in. So the Bernanke put came into place. And they said, hey, we're going to do Operation Twist, or hey, we're going to buy securities. And all of a sudden, a market that was going down for, a short period of time quickly reversed course. And then that trade that the managed futures managers had on, went very badly. So again, sideways market here. So basically, bottom line, it's difficult to predict where any investment may go. We're all kind of at a disadvantage when trying to make educated guesses in these types of markets. And so, what we want to do here in the next couple minutes is really give you some ideas, some traditional assets, some alternative assets that you can utilize in your portfolio to outperform, the general stock market. So we have a poll up next, and we're going to take kind of a quick survey here to see, have you incorporated alternative investments into your portfolio's asset mix? And so remember how we define alternatives. It's, we use a technical term that has a correlation of less than 0.5 to the S&P 500. What does that really mean, Kim? That just simply means you're not investing in stocks or bonds. Okay, it's something outside of that. So do you have commodities? Do you have hedge funds? Do you have private equity? Do you have non-traded real estate in your portfolio? We want to get a sense here for what we're looking at. And fantastic. Look at those results. We have some very educated participants. So, that's great. So 67% of us say, yes, we have incorporated alternatives into the portfolio. So I guess the question is, to what level or to what percentage have you incorporated those? Very impressive, though. So let's move on to the next slide here and talk about some of these ideas to help us outperform. Investment idea number one. We're going to stick to the traditional asset space, as I mentioned, stocks, right? So this slide really shows us what stock performance has been after recessionary periods. And you can see it's very positive. And so we can't ignore that traditional investment class. We have to make sure that we still include it in our portfolio. Now, we're going to get a little bit more specific than just saying stocks. We're going to suggest that dividend-paying stocks are really the place to kind of hang out. We're going to give you a couple different reasons for that. But you can see, 3 years after a recession, you can see some very significant performance in the stock market. After 1 year, even some significant performance. Now, what makes dividend-paying stocks more attractive in our mind? Well, as Andy mentioned, U.S. companies today, and actually some companies internationally in the emerging market space, have a lot of cash on their balance sheets. So what does that mean? Well, they have, because of a lot of the uncertainty out there, they haven't really invested in new technology, or they haven't really hired many people, and so they're sitting on cash, and eventually they're going to have to do something with that. They can't continue to build cash and not invest it either in people or pay out a dividend or do a share repurchase. So we think that's a good reason to really have dividend-paying stocks in a portfolio. The second chart here in the middle shows us that dividend payout ratios are near historic lows over the course of 1951 to 2011. So how do you calculate dividend payout ratio? Well, it's the dividends paid out divided by the net income of the company. So for that ratio to go lower, obviously the numerator or denominator has to change in some fashion. Well, what we're seeing is net income going up significantly and dividend payouts not really keeping pace with that. We think dividends are going to be increased. We've already seen, a number of companies do that. I know when I was leaving the office earlier this evening, there was a company that had increased their dividend by 50% just today after earnings. So we've seen a lot of that. Lastly, I think this chart is interesting here, the dividend yield, and just basically saying that there's a lot of dividend-paying stocks out there, so we still need to make sure that we stick to the higher quality, or the ones that will not only give you the dividend payout but also have decent performance. Okay, so that's really what that chart is explaining. American funds last year came out with a pretty phenomenal study that analyzed the stock market's return since 1929. And there was one very important conclusion that came out of that study, and I thought it was very appropriate for today's presentation. And it said that 70% of a stock's total return during that time period was from dividends. So when we're in a sideways market, like we believe we could potentially be in for the next year, if not longer, 70% of a stock's total return comes from dividends. That's a pretty strong argument, in our opinion, to invest in dividend-paying stocks. Another argument, as Andy already mentioned, you can't get a whole lot of yield elsewhere. 10-year treasuries below 2% right now. Dividends can really make a difference in a portfolio. So what would be the best way to get exposure? Well, there's really a couple different ways. So you can buy a mutual fund, that is a high dividend-paying fund. You can use an exchange-traded fund as well. We definitely recommend those for portfolios that are, maybe $500,000 or less, to make sure you're getting proper diversification but still getting those dividend-paying names. And then once you get into portfolio sizes larger than, $1 million or so, then you start really looking at individual stocks. So there's a lot of individual names out there that pay high dividends. There's master limited partnerships, there's utilities, there's healthcare, there's some of the, the big blue chip dividend-paying names out there, like a Procter & Gamble, that you can buy. We really like, and what we use in our practice oftentimes with our clients, is an exchange-traded fund. So think about the difference between exchange-traded funds and mutual funds. You still have a pool of individual names that make up this fund, but the exchange-traded funds, or ETFs as they're called, they trade like stocks, so they trade intraday. So that's a benefit. Number two, they're very transparent, and because they trade every day, really the underlying holdings on a regular basis. They typically track some sort of index out there. They're not, terribly actively managed, but when you have an index tracking fund, then you also have very low expenses. We're very cautious of expenses for our client accounts. Mutual funds, a little different, still have a pool of underlying stocks that pay dividends. You just price once a day at the end of the day, and then typically a manager who's getting paid, and they have to advertise their fund. So the expenses of the fund are going to be a little bit more. The exchange-traded fund that I was alluding to is SDY is the ticker. It's the Spiders S&P Dividend Fund. It's a fund that's comprised of about 50 different dividend-paying stocks here based in the United States. And to make this particular fund, the stocks they needed to increase their dividends on a regular basis over the past 20 years. So you can see you get a very good consistency factor here. And again, dividend-paying stocks we really believe are one of the good ideas to add to your portfolio. Maybe not just U.S. stocks, but you can also play in the emerging market space. There's a great dividend exchange-traded fund, again, that buys emerging market companies, and that would be the Wisdom Tree Emerging Market Fund, another one that we use very often in our practice. Okay, great. So that's investment idea number one. Let's focus on investment idea number two, and this is going to really curtail into our alternative, investment thoughts and how we believe that's, really a core position in your portfolio these days. So Andy talked a little bit about interest rates and where they are today, and they're very low, as we all know, and there's not a whole lot of yield to be had in the Treasury market or some of the very high-quality markets out there. Where can you really make, some extra performance or yield in bonds? Well, these are two of the areas that we believe really make sense. So the first one here on the slide is the high-yield corporate bond market. So here's just a couple bullets to tell you a little bit about this market. So high-yield bonds would be a bond or an IOU issued by a corporation that is rated, below investment grade by one of the national rating agencies out there. So Moody's, S&P, or Fitch. And when you have an investment grade or below investment grade rating, you have more risk. So you have more leverage. You have you maybe not have been around as long as a corporation. I mean, there's reasons why you get that rating. And so obviously you have a little bit more risk than a Treasury bond. Now, to make sure you're compensated for that risk, you want to make sure you're paid. So what type of yield are these bonds generating today? So today you can, or really on an average historical basis, you can get about 600 basis points or 6% over Treasury market. So if you think about what does that mean? So we said, 10-year Treasuries are around 2%. You get 6% on top of that. You're looking at an 8% yield on an annual basis to buy a below investment grade bond. So that sounds pretty attractive, Okay, so then the question would be, well, Kim, rates are at, historical lows. Why would we buy bonds now? Aren't we in a bond bubble? Great question. We believe as a team that rates are going to remain low for a couple years. I mean, the Fed has basically told us that. They said we're going to keep rates low. We need to stimulate the economy. So we're looking at, at a minimum 2014 where rates start to get increased. We think it makes sense to really add this asset class. It gives you diversification, so you're not really moving in line with what Treasury bonds may do. So if Treasury bond yields do move higher and prices go down on those bonds, it doesn't mean necessarily that the prices of the high-yield corporate bonds will follow in step. That's kind of point number two here. When you have a negative correlation, that means that two asset classes actually move inversely to each other. And I think this last bullet here under high-yield corporate bonds really applies to not only high-yield bonds in the corporate space, but also the emerging market debt space, where over history we've seen that the performance of this particular asset class tends to track that of the stock market, but with only about 25% of the risk. So, for us nervous Nellies out there, that sounds pretty attractive to me. I always tell clients that I'm definitely a bond geek. In my prior life, I managed, a bond portfolio of $1.5 billion, across the corporate bond space and the municipal bond space for several years, and I see a lot of value in owning bonds in a portfolio. Not only does it diversify portfolio, not only does it give you income, not only does it give you, that extra kick per se that you're looking for, that extra performance that you're looking for. It just really makes sense, and I don't often see that in client portfolios or prospect portfolios that come across our desk. So check your accounts. Talk to your investment advisors. Are they using high yield bonds? Are they using emerging market debt? Emerging market debt would be like a treasury security here in the U.S., but issued by a country like Turkey or like China or like India. So, really treasury securities or sovereign debt of those countries that are still in the developing stages. Those countries, you saw the slides, they have lower debt than the developed countries. They have better balance sheets. They have, better demographics as far as population goes. They have a middle class that's really starting to develop, and as they obtain jobs, they start to buy goods and services, and they have better growth than we do here in the United States. So it almost sounds like a no-brainer. And on top of that, they offer higher yields than what we can get here in the United States. So we've recently seen some volatility in this space, kind of along with the stock market, because in both of these examples, high-yield corporate bonds and emerging market debt, you will have some equity risk, as we like to call it. It's not going to be 100% correlated with the stock market, but if the equity market's down 20% bond, these types of bonds could be down slightly. They could be down 5 or 6%, so you have to keep that in mind when you're buying them. We have used in this space, you have to be cautious because, again, you're looking at higher risk securities. I know when I worked at the insurance company years ago, and I dealt with Wall Street has a whole department of high-yield bond analysts or emerging market debt analysts, and so they were able to buy individual names. What we do at OJM Group is we select the best managers out there to do that for us. And I can tell you the fund that we've really preferred in at least the high-yield corporate bond space is a fund managed by the Alliance Bernstein team. And that fund has really done phenomenal. They're top tier in their performance. The yields on the fund are running anywhere from 7 to 8.5%, depending on the turnover and the rates at the time. I guess that's another good point too. What should you expect from these types of funds in a annual basis as far as performance goes? Historically, we're looking at 7 to 9%. Over the past 20 years. That's an average annual return. With 25% of the risk of the stock market, again, that sounds pretty intriguing to somebody like myself as an investment advisor. So lastly, our third idea really is, a list of items, and those items all fall in the other alternative investment space. As we talk to clients and we see what the stock market has done over the past 6 months and how it's run up, it doesn't seem like that because the past couple weeks have been, kind of ugly out there. But, if you look at some of the returns in stocks over the past 6 months, they've been really positive. Like Andy mentioned, if you look at the returns over the past, almost 3 years now, we're up 100% in the various markets. So with that thought process and all the uncertainty out there, it probably makes sense to actually look at your stock allocation and maybe take some money off the table and put some money into these other alternative ideas and, really put some protection in place, some insurance in place in your portfolio. And that's what we think makes sense. So some of these ideas here are the various ideas that we've used. I mentioned managed futures and how they haven't been able to find a trend lately. They have, I'll tell you this, though, when, if we look at last fall, when the stock market, kind of crashed down 20% or so, managed futures were up. So they do play the important part in the portfolio when the stock market declines. One of my favorite alternative investment ideas is the first one on this list. It's the non-traded real estate space. And we actually have a team in place in-house where That's all we do is focus on that particular space. So this would be, if you've heard of a REIT before, there's publicly traded REITs and non-publicly traded REITs. The non-publicly traded REITs don't trade on an exchange per se, but they still have the same strategies as the publicly traded REITs. So they're raising money today. They're building real estate portfolios, so they have a specific niche. One of our big funds actually goes out and buys various retail triple net lease, single tenant buildings in the 7.5 to 8 cap range. They build that account, they build that portfolio, they close their fund. Their price remains stable at $10 through that entire period, which could be a year or 2 years. And then they always have an exit strategy. So they want to either list on an exchange or they want to go ahead and sell to maybe a third party to get that value on the back end for their investors. So, we'd love to talk more about it offline with you. I think it adds a lot of value. Something like this can be up to 10% of your overall asset portfolio. Stable prices, 7% type dividend yields per year, really, again, makes sense. So with that being said, I have this last slide here. This talks a little bit about the different correlations, and as Andy mentioned, we have seen assets really kind of diverge and not all move together, which is a good thing. You really, again, you want to make sure you have different asset classes in the portfolio that aren't moving all in the same direction at the same time, because that really, doesn't help with the whole purpose of diversification. So you can't just own stocks in 5 different sectors. That doesn't make sense, because when everything's blowing up, all those sectors are going to go down. Yeah, sure, one may go down more than the other, but you really have to really kind of get outside of that traditional asset class space and add some of these other ideas to the portfolio. Now's, no better time than the present to take a look at your current portfolios and review them, see if some rebalancing needs done, and of course, be wary of taxes, but never let the tax drive the investment decision. So again, thank you very much. I just wanted to spend about 1 more minute telling you how OJM can work with you as an individual or your practice or business. We offer a free consult to anyone who would be interested. We just ask that you fill out a short 3-page data form, give us a little information about yourself, and then we'll get either one of the partners or one of our planners on the line with either Andy or I, and we talk about some of your concerns, some of your questions, some of the things we see on this data form, and we give you some of our thoughts and recommendations. And at that point, you can determine if anything sounds interesting, and if it does, then you can engage us. We can do personal planning for you. We can do corporate planning for you. And you run through a year-long process where we review a lot of different items and make sure we add that value. Our partners also can come if you have a practice, an office, a business. We can come to your office and do a talk for CME credits, and then we just would ask that you cover the travel expenses for us to do that. That's been very successful, and actually I know that we just had sent out an email to our prospects and clients where David and Jason are going to be speaking at a conference in San Diego, California, I believe, in early June, and they'll be 2 of the presenters on the panel there. So lastly, sorry about the pictures. You couldn't see our books. Everybody here gets a free book, so let us know which one really makes sense to you. On this next poll, we're just going to ask you, what's the best way to contact you? Should we give you a call? Should we send you an email, send up a smoke signal? All those and any of those will work for us. If you could go ahead and just select what is the next best step for you, that would be great. And we'll go ahead and check the results after the webinar. And I'm going to go ahead and just, let you know here on this last slide how you can reach us. So we have our toll-free number. Kathy at ojmgroup.com is a good email to use to arrange a free consult. Andy and I have pretty easy email addresses as well. Mine's kim@ojmgroup.com, and Andy's is actually A. Taylor, Taylor, @ojmgroup.com. Of course, we have a lot of great information on our website as well. We're really about analysis, education, and then implementation. That kind of defines what OJM Group is. So with that being said, we kept it to under an hour. We know time is precious to everybody, and so I don't see any questions here. Again, if we missed something, you want to chat offline, definitely give us a call or send us an email, and we look forward to talking to you. And please have a great evening and a great weekend, and thank you again for joining us. Bye-bye now.